Hello everyone, this is Jose Blasco. We are about to start. 20 seconds to go. This is a sound check, please. Everybody, please give me a quick confirmation on the chat box so I know you hear me. I know all is good when it comes to sound and sharing a screen and video and all of those things. So please give me that confirmation so I can get started knowing all is good. Thank you so much, guys. Here we go. We just reached the starting time of the session, so we are live. I will turn on the stream. How are you, everybody? Welcome to the session. Jose Blasco here. A pleasure to join you today. Today is August 23, 2020, and today it's sharpening time. So basically today the idea is that I am at your disposal, ready to answer your questions. So I'm counting on you to have questions probably derived from your practice and your time spent mastering the skill of trading with the markets, either with real money or paper money. But again, as you practice, I'm sure you are realizing, how the markets work, how, work the trader in you, because of course, trading emotions are a key aspect of trading and we are all different, isn't it? So again, today the idea is to talk about everything and beyond when it comes to trading and your own experiences and where you are at in your learning journey. And more than happy to be here to give you the answers and to work with you to help develop yourself. Okay, that's the plan for today. Before we start, so make sure you have these questions ready for me on the chat box and so on. But as we start, I would like you to read the disclaimer. So please pay attention to the disclaimer. It's obviously very important. So please read it. Following videos, clips, demonstrations are for educational and instructional purposes only. Please read the whole paragraph there. It's very, very important, as said before. Okay. Very nice. Okay. Cool. Perfect. Very good. So everybody, the session is now officially introduced. Maranu, it's good to see you. How are you, Maranu? Good to see you all. And again, today is Q&A, guys. Okay. So I don't have anything specific to address. We can talk about anything about the markets or about your trading and as I said, where you're at in your learning process. So go for it. Okay, ask me any question, and I'm more than happy to work with you on that. But today there is no topic, a specific topic, as well as the market is closed today, so we're not going to be trading today. So I'm simply here for you guys. Okay, so make sure that you communicate with me and don't be shy. Okay, and we're here to learn. There was a time where I was a student myself. Okay, and I could understand being a bit shy or undecided about asking this question or that question. So I can get it. But again, we are here to learn. So feel free to interact with me for that purpose. Okay, guys. Very good. Also, while I give you a little bit of extra time for you to begin typing. How are you, Mark? Good to see you. Yeah, burning California. This is very, very sad news. I was watching some camera shots on TV the other day, and it certainly breaks your heart. Okay, certainly breaks your heart. Anyway, hopefully things get back under control soon. Maranu, fine, Jose. I hope you're fine too. Yeah, thank you very much, Maranu. Very kind of you. I am indeed fine. Always wonderful. Thank you so much. Thank you so much. Same to you guys. So again, looking for your trading questions on the chat box. Also, I was saying that while I give you a little bit of extra time for you to type, there've been many times where, and I guess it's kind of random, but there've been many times where before doing a sharpening session during that week, you guys sent a collection of emails with questions, knowing that sharpening was happening, and you were preparing for it. And sometimes your questions were very simple, so they were responded back to you via email, and that's it. Sometimes your questions were way more complex or advanced, or could simply not be responded in an email, given the density for the answer. And in that sense, in those cases, I would bring the questions to the sharpening session, and I would maybe be the one asking the question at the beginning, because I had one or multiple questions ready out of the emails that you guys have sent. But again, as I was saying, I guess it's a random thing. in this prior week or weeks, the emails that we have received when it comes to support were quite simple. I guess that that's what it is, which probably is a good news because you guys are mastering the use of the apps and trading. So that's a good news. But basically, what I'm saying is that I don't have any specific question to start the day with. So I'm basically waiting for your questions. Okay. So yeah, Maranu, Forex, please. No problem to have questions on Forex, but I need you to be a bit more specific, right? Obviously, this is not a Forex course where I would start teaching Forex from zero all the way to 100. So go ahead and ask me specific questions about anything you'd like, and I'll be more than happy to check. Yeah. Yeah, Euro US dollar, Maranu, as well is not a question. If you're asking me to plan a trade on the Euro US dollar, I mean, I could certainly do that, but then you will need to tell me which time frame, what is your style, based on the process that we utilize when we do trading of forex in Maranu. We're using very specific set of time frames. We have conducted sharpening sessions in the past where we talked about all of this. So again, I need you to be specific with your questions so I can give you specific answers. Okay. Mark, supposed to be more lighting from tonight to tomorrow night. Okay, got you. Well, I don't know the consequences of lightning, to be honest. Hopefully the lightning comes with some water coming out of the sky, and that should help. Not that it's going to be much comfort, Mark, but in my country of origin, in Spain as well, in the Canary Islands, to be precise, they also have very major fires as well on the mountains and stuff. And yeah, it's I guess it's the season of the year, isn't it? Apart from sometimes these things are unfortunately man-made, right? But yeah, it's also the season of the year. Everything is very dry, and yeah, so that's what it is: high temperature and dryness, and then maybe someone did something wrong, and that's it. Yeah. So my friends, again, I'm in your hands. I am in your hands for you to ask me questions about trading. So feel free to do so. Maybe I should go ahead and close the introduction slide because the session is already introduced. So here is TradeStation. I also have TradingView ready. But guys, at this point, I would really need you to begin asking your trading questions. I can see we are a group of people connected to the session as of now. So I'm sure you guys are trading or have trading questions, okay? And go for it, okay? And by the way, if you are not trading, okay, let's say you are joining us for the first time and you never trade in your life and you have super crazy basic questions about trading, go ahead and ask me, and I'm very happy to talk about anything from super basic to super advanced. I have no problem. But again, I'm here for you today. So I really need you to take the lead on asking questions so I can provide answers, because if that's not the case, I think today is going to be a short session, guys. That would be sad. We do a sharpening session once a month, so I'll be counting on you to take advantage of this, okay? So don't be shy, guys. Don't be a stranger. Okay. So I'm not sure if you guys are typing. So let me be the one asking you questions. Okay. So you guys, please go ahead and type on the chat box. Where are you located at, as well as which markets do you trade. Let's begin there. Maranu, what do I think about demand and supply zone? Okay, so let's talk about this. Mark, I am still having a hard time determining how much of my money to have invested in long-term trades versus short-term trading. I get you, Mark. Okay, very good. So let's talk about both questions. Very good. Glad that you guys, opened the door to questions. Okay, I was a bit concerned for a while. I'm like, hey, can it be they have no questions? When I was a student, I was always, overwhelming my instructors with questions. Anyway, so Maranu, let's begin with your question. Okay, what do you think about supply and demand zone? Okay, so first of all, obviously this is a very, very generic question, because in the world of trading, there are so many different traders that use the same words and mean something totally different. Okay, so the term supply and demand could be used by economists, and totally completely related to fundamentals in a market, for example, okay, and talk about the supply and the demand in a market, fundamentally speaking. Other traders that are technical may be referring to demand or support, to the same thing that market analysts would call support or resistance. Other people in the market that maybe Fibonacci traders may be talking about Fibonacci retracement lines or even extensions to what could be either support or resistance or supply and demand. Other people could be talking about supply and demand, when referring to the news. So again, it's a very generic term, okay? And Mariano, in this case, I would really love if you could tell me a bit more, from which angle you are observing supply and demand, because it could be observed from so many different angles. It's a very generic term, and I would like to make sure I understand, where are you coming from, when you are thinking supply and demand, so then I can put myself in your shoes and then tell you what I think about it, on how you, but first I need to know, what is it exactly, what do you think about when you think of supply and demand. So can you please share with us, what is your definition of supply and demand? Where are you coming from when it comes to understanding supply and demand? And from there, I could get back to your question and elaborate much more in depth, because again, it's a very, very generic term, okay? It's a very generic term. Mark, I am still having a hard time determining how much of my money to have invested in long-term trades versus short-term trading, okay? So I'm gonna, Marano, if you don't mind, I'm gonna take care of Mark's question, and that way I give you time for you to type the answer to my question, okay, which is, again, what is supply and demand for you, okay? And in the meantime, I'll be taking care of Mark and then back to you, okay? Cool. So Mark, the key, okay, the key when you are trading is that you have a plan, okay? That's the key. If you don't have a plan where it's determined and defined on how much you want to risk per trade, how much quantity of your capital you want to have in a trading account, how much percentage of that capital you want it to be allocated in trades at all times, and how much money you want to leave freed up of trading at all times. So if you don't have all of those parameters identified, then you have a problem. Obviously, I totally understand that you understand that, okay? And your problem is not to understand you need to have those parameters. Your problem is to define which are the ideal parameters for me. Okay, I believe that's really the real origin of the struggle, is not to have a plan, is to not to know what to put in the plan. Am I correct with my interpretation of your question, Mark? Can you please confirm if I am correct on that? What is your take on using hedges when selling options as opposed? Okay, got it. So I'll be back with you in that other question in a minute, Mark, as well. Okay, good, perfect. So I appreciate your confirmation that what I said is exactly what you're thinking. Perfect. So now, with that said, I would like to let me open a document here on my slide, on my side, which is a slide, and this will hopefully help you. Right here we go. So what you can see here, it's basically the introduction slide of our Forex course, okay? And again, what I'm about to point at is slide number 5 of our Forex course, okay? I want to point at this particular slide so we can talk about it. I'm sure that many of you have taken our Forex course. By the way, out of curiosity, the next one, we are running it on September 21st. Okay, so if you want to be part of it, you just need to register for the course on our website. Okay, on the join menu. Okay. But anyway, going back to my question. Okay, so look at slide number 5 on our Forex course. Okay, so why are we talking about measuring the quality of our trading methodologies leading into expectation? Okay. Why are we doing that? Okay, why are we talking about at the very, very, very beginning of the course? Why are we talking about calculating expectation? Okay, and here's the formula and everything else. Why? Well, because if you don't know what to expect from your methodology, or even beyond that, if you don't know what to expect from a specific methodology applied by you, right? Because the same methodology applied by two traders will probably very likely produce different results. Okay, why? Because trading is a psychological game, big time, and two different traders with a different mindset, and we are all different, isn't it? So we have very likely a different result. So the idea in trading in general, and that's why we talk about this very early on the Forex course. The idea is that when you get yourself ready to start trading and you have acquired a methodology, you give yourself the opportunity to practice such methodology in order to calculate in order to acquire sample data and sample results, so you can go ahead and calculate your expectation. Take a look at this. So let's say a trader has collected enough samples from a trading methodology, wants to know about the quality. Let's say after a few trades, you got 48% of the trades that profit. Let's say the average reward to risk ratio is 2.1 to 1. So the expectation based on the prior formula would be 0.48 times 2.1 minus 0.52, that's 0.488. What does that mean? Well, that let's say you were to be a person who has time to take 2 or 3 trades a week. So that, let's call it, it's 89 trades in a year. Okay, a year is made of 252 trading days. So if you take trades twice or maybe 3 times a week maximum, or maybe sometimes 1, maybe sometimes 2, maybe sometimes 3 times a week, something like that. So let's say you are that person and you collected in 1 year 89 trades, and every time you were trading, you were risking 1% of your account. Okay, how are you, Boyan? Good to see you. How are you, Trade with Danny Wu? Good to see you, my friend. So the answer for that trader would be that the expectation is to produce 43% return by taking 89 trades in a year by risking 1% per trade. Okay, and it's important that you know this, because if you know this, you're killing 2 birds on 1 stone. And this is the answer to your question mark. If you know this, first, you know what to expect from your trading method. So you are really mitigating the impact of trading psychology in your trading actions. Because let's say when you collected, let's say 100 trades that you practice, right? And that's your sample data. During that time, so there may be times where you had 3 losses in a row, 4 losses in a row, 5 losses in a row, 2 winners in a row, 3 winners in a row, 4 winners in a row, whatever that is. So you've got to see what happens when you trade, and on top of that, you know the results, right? So let's say now you're trading during a particular month, and the month is about to be over, and let's say you have made 5%. If you were to make 5% every month at the end of the year, that's 60%, isn't it? Your expectation is 43, but you are already up by 5% in a month. That would make you up to be 60% in a year. So you will know that 5% in a month, in your case, if you were to be this guy, is a good thing. Okay? For other people, maybe it's not. Or maybe you want more. So then instead of 89 trades, you take double the trades, right? Or you increase the risk instead of 1% to 2%. But my point is that by knowing the expectation, first, you are never surprised by what's going to happen to your trading results because you've seen it before, and therefore that helps you to keep your emotions under control and keep cool. The second thing is that now that you know you are about to produce 43%, in a normal case, of course, you can have deviations because probabilities are probabilities. But, and you could certainly account for deviations too. You can calculate a standard deviation of your results or something like that and calculate for that. But my point is that now that you know what to expect, it's an easier exercise and math, Mark, to go ahead and look at, okay, so I can produce 43% if I'm this guy. I have X amount of money. So that means that I could make X amount of dollars in a year. Is that enough or not? Oh, I only need half. Okay, so what about I allocate half of my money into that investment account, right? Or, oh, you know what? I actually need more. That's not enough. So then, well, you have no choice. We either find more money or raise more or trade more often. But at least you know what to do, right? And having this sample data and calculate your expectation, it's basically the beginning part of defining parameters such as how much money should you have in your trading account, how much money should it be invested versus how much money should be left in cash. Okay, Mark. Hopefully this helps you to answer the question. Okay, it's critical, of course, that you don't put your money in the market and you start trading without being ready. Okay, and without being ready means that, if you know a methodology perfectly, but you have not given yourself the opportunity to practice it with paper money or a very small size, just so you get sample data. If you never gave yourself the opportunity to do that, then you would be basically guessing. You're gonna be guessing and hoping together at the same time, because you're gonna be like, okay, I got 100K, So I'm going to have 100K in my account, and hopefully I'm going to make that amount, which is what I would like to make, right? And it's a guess plus a hope, which is not, those two are not good allies in trading. I guess is common sense. Okay, very good, perfect. Good one, Mark. Very, very good question. Okay, so I'll go back to Maranu. Let me see, Maranu. Maranu, I am reading the chat box. I don't see any answer from you to my question to you before, and I really need you to define what is supply and demand for you, because if you don't tell me what is supply and demand for you, I can only talk generalities. Okay, I would like to be specific to give you my opinion about supply and demand, but the way you think about it, right? Because if there are millions of traders in the market trading, so you could have a million of different definitions when it comes to what is supply and what is demand. Okay, so it's a very generic term, and I would need you to be a bit more concrete for me there. Okay, so please go ahead and type that if you can. Okay. Okay, I have another question from Mark here. Okay, and then yeah, Mark, backtesting is a very, very, very healthy process because it will help you to understand who you are as a trader. It will help you to understand and master a methodology. It will help you to understand you applying the methodology, and it will help you to get at least initial sample data, which is backtested, so it's not real. But at least if your backtested data doesn't look good, you don't need to raise money. Is that making sense? But if your backtested data now looks good, so now you will want to either forward test or ideally paper trade or trade with small size to have a sample data which is significant and relevant. Okay, but without backtesting, again, you would be hoping that the samples you are about to collect are going to be good enough. Okay, so to me, it doesn't make sense to trade even with paper money unless you know what you have in your hands. So backtesting is certainly something absolutely critical. Okay, yeah. Okay, so while I'm giving time to Marano to type, and also I see you have trade with NU. I can see that you also have a comment there. So I'll be back to you in a minute. So Mark, a bit higher, has a prior question I would like to address, and after that I'll continue with the following questions. Okay. So Mark, second question from Mark was, what is your take on using hedges when selling options as opposed to using stops on the premium? Okay, cool. Okay, so I have many answers to that question, or one answer but coming from many angles. Okay, maybe that's a better way to say it. So Mark, first of all, having stops based on premium of the option, the way I think about it, it's kind of like a hopeful stop, meaning that you sell, let's say you sell an iron condor or a credit spread, and you collect X amount of premium, and you're like, hey, if that stock or that market goes against me by that amount, I'm willing to risk that amount, so I'm gonna have a stop at this price, and if that happens, I'll be out, and that's it. Okay. While from a risk management point of view, it could make sense. From a trading point of view, and what I mean by trading is timing the market's point of view, being right or wrong on the directional move of the stock point of view, right? From that point of view, having a stop based on premium is totally inaccurate because the prices of the options, the premium, vary not only based on the price of the stock, but based on other factors as well. So it's kind of like, okay, so I know that's how much I want to lose, so let's hope it's gonna be okay. It's almost like, to me, it's almost like you went to the casino and it's like, hey, this is how much money I got to bet for today, so I'm just gonna throw I'm gonna pick that number in the roulette or whatever other game you play, and hopefully I'm gonna be okay, and if I lose, that's how much I'm gonna lose because that's my limit. Okay, so there is a little bit of hope built in that one. Okay, and I'm not too happy about that, given the fact that options prices derive their value from things other than only the price of the stock. Okay, the stock or the underlying, if you do options on futures or options on an index or whatever, options on currencies. So that's one angle. Okay, I'm not happy about that. Okay. Second, when you do non-directional option strategies or neutral option strategies, meaning credit strategies, typically you will not sell options that are too far from your starting point. Typically, you will sell options that are that have strike prices located far away from the current price when you start a trade. Typically, okay, there are different styles, and maybe someone out there, selling at the money options or in the money options. Okay, great, but that would be really quite directional. Okay, normally the majority of credit traders, and I believe that's you too, Mark. When selling options, you are hoping the options to remain out of the money. Okay. So in other words, if the market reaches your short strike, right, and now you are in trouble because an option you were expecting to stay out of the money is now at the money or in the money, so that means that price has traveled a lot against you. And normally you have a rubber band effect in the markets. It happens most of the time. When a market is moving very far in one direction, it will bounce in the opposite direction because there is a lot of profit taking. Many people may see that as an opportunity to enter in the opposite direction, and again, now you have a bounce. Okay, so if you were to have a stop based on premium, it could be quite common that you get stopped out. And in one hand, it's fine because you lost what you were expecting to lose. But then next thing you know, now the stock is back to be moving in a direction where your options that were in the money now are back to be out of the money, and now you would be in profit, but you already collected your loss. So it's a shame. Okay. And the third angle I would like to mention is the fact that on top of that, with options trading, especially if you trade options on equities or ETFs right at the market open, there is a great probability for slippage, even if you trade liquid products, because on how market makers take advantage of traders right at the open with a process where they collect a months of capital, huge amount of capital based on arbitrage opportunities, and people get slippage, like major slippage. So if you were to have an order to close a trade because you reach a certain level of pain, you may get a lot of slippage on top of that, and you end up in a very problematic situation. And if you were to use a limit order to do that, well, then you may not get filled because a limit order does not guarantee the fill. So now you are partially unprotected on a trade where you thought being protected. Okay, so as you can see, I got a collection of problems with exiting a trade the way you mentioned, right? So in other words, I believe that hedging is a much smarter approach to protecting an options trade when the market went against you, where you could get hurt because certainly when you enter a hedge, then you have to undo the hedge. And if Murphy's Law was to happen twice in a row, you can get hurt on the spread or the iron condor or any option strategy you're using for a credit, while you can also get hurt on the hedge. Okay, this could happen, but normally the hedges will be more helpful than not. And certainly you have an opportunity to make money in a directional move against you, where then you end up profiting from the credit strategy you entered at the beginning, right? And therefore, I think it's a much smarter approach to protecting a position when things go wrong. Okay. Also, normally when you do hedges, you will not use options, right? So if you are doing a trade with a stock, you would hedge with the stock. If you're doing a trade with futures, you would hedge with futures. You would use markets that are very liquid and normally use the underlying asset for the hedge, where the probability of slippage is much less, and you can enter and exit at a very fast pace. So again, there are many advantages of approaching it this way. Is it the only way? No. Is it wrong to do what you are suggesting? Well, I don't think it's wrong, but I did state a collection of these advantages that, to me, makes it how do I put it, less efficient, okay, and actually riskier at times. So that's my answer to you, Mark. Okay? Hopefully this makes sense. Very good. So next one. Okay, Maranu, you can see that you are giving us an answer when it comes to demand and supply. So demand, in my opinion, is a request or a base to buy, and supply is a stock or a base to sell. Sorry, you're not fluent on using English. It's okay. It's no worry, Maranu. It's great that you are doing the effort, and English is not my first language either, so I really appreciate you explaining it in a written form. Okay, so thank you for that very much. So basically, you are saying that demand, in my opinion, is a request or a base to buy, and supply is a stock or a base to sell. Okay. So question for you, Marno, just to make sure I fully understand what you said. So when you say a base, do you mean like, for example, all this price action right here is going sideways, right? So because all of this price action is sideways, you would call this demand. Is this what you mean when you say base? Okay, please go ahead and answer yes or no to this question on the chat box. Would you call that purple box demand based on your definition of a base? Yeah. In the meantime, I'll be reading the comments and questions above. Okay. So while we give Maranu a little bit of time, trade with Danny Wu. Rules-based strategy will make us to get to C word, and we need consistency to make it happen. If we got our rules-based strategy and it works, what do you think if we use a robot or an easy or an expert advisor on MetaTrader? Yes, absolutely. I love it. That's what I do for myself. So yeah, absolutely. The beauty of doing that is that you remove the human component out of the equation. Okay, so it's certainly very, very advantageous. The problem is that it will take you years and years to fine tune your code. That's the problem. Okay, this is at least this is what I went through myself. Okay, why? Because the market scenarios, market situations are going to be very, very, very diverse. While your methodology is a methodology based off a simple set of rules, then there are many more things to be managed as a trader, which is very easy to be done when you're human, but is very tedious to program if you are not human, right? So, for example, let's say you get into a trade with the euro, but then the British pound also gives you an opportunity 2 hours later. So what do? Do you take the trade with the euro only and you ignore the pound, or you take both? Right? How are you going to manage the risk for your portfolio? Are you going to accept 2 trades at a time or not? Or, so again, there are many more things like that will happen that not only affect the one chart you see when you trade. Okay? There are many, many decisions. And for every one of those decisions, your programming, all your automation, your robot, your expert advisor on a MetaTrader need to take all of this into consideration. So it's not only about analyzing the chart. You have a good price point to buy. Of course, if you could automate that, go for it. It's very advantageous. But what about all the other surrounding conditions, right? What if you are trading the methodology and suddenly you get 5 losses in a row? Well, what may that mean? Okay, this may mean that something very, very crazy is happening in the market. Okay, like for example, earlier this year with COVID, where even some markets got limits, right? The heat limits, the market were frozen, trading stopped in many markets. So how is your code going to react to that if you have not programmed it? Okay, so the experience I went through myself is, it took me years and years and years of programming to keep evolving my codes to a place where basically things can be in autopilot. But believe me, it's not going to be version 1 or version 2 of the code. You're talking about a multi-year process to get to that point. Okay, but if you know how to program, certainly I would like to encourage you to do it, because it's beautiful. Now you just push away the human in you, and it's all about the objectivity and the perfection of execution a computer have, which is much more than a human. Okay, so why not? Yeah, absolutely. Very good question. Mohammed, nice coach. Well, very kind of you. Thank you so much, Mohammed. Let me see. Okay, so we have the answer from Maranu. So demand is RBR and DBR, and supply is DBD, RBD maybe. But I want to know where the demand and supply are strong. Oh, I get you, Maranu. So what you are defining as supply and demand is a definition from one school that teaches people a methodology that they call supply and demand. I get you. So the RBR is the rally-based rally, the drop-based rally, and all of these things. Yeah. So my take on that is that while the concept is very relevant, which if you think about it, the concept behind the UFOs I use. Okay, it's very similar. Okay, in the sense that there is order flow at those price points. When price gets there, orders will get filled. Price will move in the opposite direction. So you could be thinking of, buy on field orders here, sell on field orders there, buy on field orders. You could think about it as demand. Sell on field orders. You could think about it as supply. Okay, but assessing those price points by only looking at, those RBRs, DBD, all of that stuff. How do I put it? I want to be clear, direct, while respectful. Okay, it's a bit too simplistic. That's how I'm going to put it. It's just a bit too simplistic because there is a lot of data you need to observe to find out if that's the case or not, which is not visible on the screen. So on the screen, the only thing visible when you load a chart, no matter the market you trade, is the high, the low, the open, and the close. You get candles and you see the high, the low, the open, and the close. That's all you see. Okay. So when you see, candles going sideways like that, and then you have a move, so you may call this a drop-based rally, right? A DBR. Okay, great, perfect. But how do you find that? You found that by assessing the high, the low, the open, and the close, right? And that's only one tiny, tiny piece of market information that may reveal or may not reveal to you the real intention for those institutional players. Because in order to really reveal if there are orders and orders are still there, is to assess data which is not visible, such as the quantity of up volume that took place in every one of those candle charts, the quantity of down volume that took place in every one of those charts, the quantity of up ticks, the quantity of down ticks, the quantity of volume total given the range of the candle, the quantity of up volume divided by the quantity of up ticks, vice versa with the down ticks. So there is a lot of mathematical calculations that cannot be done at the speed at which is required, and that information is not even seen on the chart. So my take on your definition of supply and demand is that while as a concept it's very, very, very relevant, the application with the DBR, DBD, etc., that application is absolutely incomplete and quite hopeful, especially when applied to larger timeframes. Okay, especially when applied to larger timeframes, because you withdraw some of those chart patterns, and basically you would expect that even if it takes 20 years for price to come there, you would have a reaction to it, and it's way too hopeful. Okay, it's way too hopeful. It's no way orders are going to be waiting there, waiting for so many years. So that's my take. While it's very, very relevant, it's quite incomplete. There is no way. I mean, in the 60s, in the 70s, even if you wish in the 80s, even if you wish beginning of the 90s, I would say maybe that could have been a relevant technique on how to approach trading. But since the 90s and late 90s and beyond, where computers took control over the markets worldwide, all markets, and computers are super fast, and computers are co-located in the same buildings as the exchanges, and there is a lot of games being played with placement and cancellation of orders and hiding true intentions and all sorts of things. There's no way you can look at a chart and just by using your human eyes assess enough market data. I mean, everybody would be making fortunes if that was the case, isn't it? Even with using very advanced technology. Notice, for example, with McDonald's, 53% of those UFO works, which means 47% didn't. Okay. Well, by the way, even the UFOs and even the definition of supply and demand, the way you just define it, even those definitions have another problem, which is they will not work as well for all the markets you trade, or even for the same market. Depending on the time frames, you will have differences on performance. Okay, why? Because orders that are placed in the market, which is your demand or supply, they tend to be canceled if they are not filled when it's the right time. Okay, you can see clearly that for some stocks, for example, McDonald's, okay, there is 53% performance. If I move to pre and post market, okay, you got 43% performance, meaning that certain orders, which you still see charts, right? You still see candles. But certain of these orders are canceled if they are not filled during the pre or the post market. Okay, so for a stock like McDonald's, it would be more relevant to use regular hour data. Okay, if you look at a market like the euro, okay, so the euro, for example, is giving you 55%, okay, with a 55-minute time frame. Okay, if you drop to, let's say, a 5-minute time frame, it's giving you 51%. Change of same market, change of time frame, and you got a difference in the performance. So this is how dynamic all of this is. Okay, orders are in different places, they keep changing, they are canceled, so you cannot just find something on the chart and just draw your lines, because with our human eye, you find the high, the low, the open and the close, and you draw a band. While the concept is very relevant, the application, in my opinion, humble opinion, it's very incomplete. Okay, Maranu, this is my answer to your question. Okay, thank you for that. That's a very good question. And again, I needed you to define what is supply and demand for you, because again, there are millions of different definitions. Okay, millions of different definitions. Okay, let's keep going. Rianto Chandra. Okay, I want to ask about using the EMN9 common time frame. Is it applicable to any market, or is it just for the Forex markets that fully automated? How about with market that's not too liquid as Forex? Yeah, absolutely. The 9 EMA, you could apply it to any market. It's the most common of all the EMS. So you should get a reaction no matter the time frame, no matter the market. Okay, but again, when you start trading, and we talked about it briefly earlier with Mark, it is very highly recommended that you backtest it. So let's say you have been trading the EMNI methodology with the euro using the 5-minute time frame, and you are very happy, but now you are about to apply it to crude oil, and you never traded crude oil before. So before you start trading crude oil, just backtest it, so you get to see the results. You can measure it, so you know your expectation, as we discussed earlier with Mark. Having said that, I'd be, let's call it, shocked if you were to come back to me and say the differences in performance were huge. It's like it was a disaster with the crude oil, it was amazing with the euro, or it was a disaster with the euro and it was amazing with crude oil. I would say that's not going to happen. Okay, there are too many computers nowadays utilizing techniques like that, and again, that's how markets work nowadays. Okay, so yeah, so that's my answer to you. Very good, Mark. Can we get an updated copy of the document that contains all the rules so far on options? Do you mean, Mark, just to make sure I understand, do you mean this document? You mean this document? If you mean this document, the answer is yes, but know that there is no updates. It's a long time we have not worked on this document, so it's exactly the same document that we used to have. But if you want to have it, or if you don't have it, or anyone, if you would like to have this document, just send an email to support. Let me write it down. Support at tradewithufos.com. Okay, and the team will be happy to email it to you. Wonderful, Mark. No problem. Denny, Jose, I meant if we use the methodology based on the traddictiv flow chart, I found it on another sharpening sessions. It's enough to convert its automation tool to EA. Yeah, well, Denny, trading goes beyond a chart, isn't it? So you need to have a trade plan. You need to define how much money you have in your account. You need to define how much capital you raise per trade. You need to define what time of the day you trade. So there are many more things that are not on the flow chart. Okay, so the flow chart is this. Let me bring it. This is the flow chart, isn't it? So the flow chart is telling you the steps to plan and execute a trade. And this is easy to automate on any programming language. You can go ahead and do it, no problem. And certainly good idea, as I said. But beyond that, there are many other decisions, right, that you need to make as a trader. how much money you have in your capital, how many trades you want to take in parallel. If you take multiple trades in parallel, how much your risk per trade? Are you looking at correlations or you are not looking at correlations? I mean, you need a trading plan. Okay, you need a trading plan. Okay, and all of these also need to be programmed. You cannot just execute every single trade that meets the rules without having into consideration your business rules. Trading is a business. You need to have a plan at a business level, and then you need to have a plan at a trading level, which is the rules. So the rules are easy to automate, but there are many, many other additional surrounding conditions to those executions, okay, that may stop you from trading, okay? Like, for example, when we are running sessions together here in the channel, there are times where the trades I plan during the session, I take them too. And there are times where I don't. Okay, so why is it that there are times where I don't take the trade? Well, maybe I am already in too many trades in my account. And if I was to take one more, I am exceeding the risk for my portfolio. And I don't want to do that because I will break my rules, right? So, and I don't do that. So again, there are multiple additional conditions that you will need to keep under consideration to have a proper methodology that you have automated. If not, what you have is an interesting tool, but it would be an incomplete trading methodology. And sooner than later, you're going to get in trouble because there will be one day where the market is moving crazy. And next thing you know, your expert advisor triggers entry in 10 currencies at the same time, and 10 currencies at the same time go against you, and you get a major margin call in your account. Okay, so you need to have all of this under control by not only programming the steps, but more than that. Okay, having said that, for sure, the steps is part of it, and you can certainly base your programming out of the flowchart. Okay, this is how actually you will want to do it. So Danny, hopefully I did answer your question now in a more complete manner. Very good, everybody. Maranu, how are you as well? I don't see any comment from you. Did my answer to your question make sense? Are you with me? Again, this is going to be recorded on the YouTube channel, obviously, so you can listen to it again if needed. But I would certainly like to know if my answer made sense to you, didn't make sense to you, or if you need me to repeat anything, I'm happy to do it. Okay, same to you, Danny, as well. Same to you, Mark, everybody. You guys let me know if all is good. I'm just reviewing that I haven't missed any question. Yeah, so it seems that so far is all good. Yeah, Danny, thanks for that. Thanks for that. Okay. Cool. Well, it seems that there is not much more interaction in the chat box. So I want to give you one more time the opportunity to phrase any question you may have about trading. We've been in the session for almost an hour now. And again, I'm happy to extend the session. That's not a problem. But again, today is a Q&A day, isn't it? So hopefully you guys have questions for me. Ahmed, good to see you, my friend. Thank you for that. Okay, if you see me looking down, it's just because I'm reading the questions on the chat box, okay? So I want to make sure I don't miss anything. Jose, when we have a new UFO form, is that a question, Boyan, or that's a statement? Marano, thanks, Jose. Maybe I want to see the record and translating again. Got you. So, Jose, when a new UFO forms, and then time in trade, I'm not sure what is T in T, time in trade maybe, comes in effect after a new UFO or the initial entry. Too fast. Oh, okay. Too fast, too soon. Got it. Okay, I get you. Yeah. The fact that new UFOs form don't affect the rules for the too far, too fast. Okay, it doesn't affect it. So what it allows you to do is to trail stop to a better location, better because hopefully it's closer to your target, up if you're long or down if you're short, and also better because it's located on the other side of a UFO, which is likely going to protect price from stopping you out, and therefore, continue pushing in that direction. So the fact that we have a UFO that just formed means that it's kind of like it's not too far too fast any longer. Is that making sense? But if before that UFO formed, you already had that condition met, so apart from trailing based on that UFO, you would also keep trailing based on those projections of price movement based on the one-to-one calculation. Okay. Okay. Yeah. Makes sense, Boyan? Is it clear now? So maybe a better way to phrase it is, uh, if you ever if in your trade you had a situation where price traveled too far too fast, that remains until the end of the trade. Okay, so you will trail based on any of the rules that have you act on trade management. So I have my, did I close it? Yes, I think I closed it. Let me reopen it. So if I reopen the flowchart, okay, and we have, the time stop, the safety target, the climate change, the too far too fast, the UFO trailing exit, and the final target. We have all those different possibilities for exit, apart from, of course, a full stop. Okay, so if we have all of these different possibilities, okay, you are just acting on all of them. And if at any moment in time this one triggers, because price traveled all the way without forming a UFO, so even though after you may have UFOs and you are also trailing based on those UFOs, every time you have this additional move, additional move, additional move, you keep bringing the price up, no matter if a UFO form or if it didn't. And if a UFO form and this, let's say the UFO is now here. Okay, let's say the UFO is now here. So your stop should be here, but now you have an opportunity to have the stop there. So then you keep moving the stop. Okay, so it's basically, if that condition has ever been met, so apart from all the other reasons why we manage the trade, that reason remains. Okay, that reason is not invalidated because then after a UFO was formed. Yeah, got it. Perfect, everybody. So, my friends, I think that we're gonna call it a day. The session is now over. My pleasure joining you in the session today, guys. I hope all of you, especially if you are in the US, are ready to support Fernando Alonso on the Indy 500 race. He needs support. He's starting on position 26. Okay, and it'd be great that he wins the race. So we need a lot of energy for Alonso this weekend. Okay, so enjoy the race if you are into that. And if not, enjoy the rest of the weekend, my friends. I will see you soon, my friends. Take care and keep up the good work. And don't be shy, okay, guys, in future sessions. Next month, we'll do sharpening again. Bring in your questions. Don't be shy. And if you are shy, send an email before the session, like some of you do. Not this time, but many other times. Some of you have done that, which is to send an email with the questions. And then, I can just get the email on the screen and I can hide your name if you want me to. And then go over your questions and give you answers. And, you don't need to feel shy, okay? Everybody, take care, everyone. Bye-bye.